Thank you guys for coming today. This is the first time I've ever spoken in front of a group of CPAs, so please be gentle. Feel free to correct me if I give you wrong information at any point in time. There are mistakes probably in this presentation, and I put them in there intentionally to make sure you're all paying attention. So the title of this presentation is called Tax Planning and Investing in the Year of Obamacare. My name is David Warrick. I'm a certified financial planner, and I host a radio show called the Tax Reduction Network, which is on WFYL 1180 on Saturday mornings from 8 to 9 a.m. Rather than take notes, I gave you copies of the slide presentations. If we run out and you don't have enough, please send me an email at the end of sometime this week, and I'll send you a PDF of the entire presentation you have in front of you, as well as the notes that I'm reading from if you'd like a copy of those as well. So I'd like to get started. On March 23rd, President Obama signed what's called the Patient Protection and Affordable Care Act. On March 30th, he signed the companion Healthcare Education and Reconciliation Act of 2010. Together, these two acts represent the biggest change in how we finance healthcare since Medicare was created in 1965. They also include some of the most significant tax changes in a generation. Healthcare reform, as we all know, has been an intensely political process. Not one single Republican voted for the law in either the House or the Senate, and polls show that Americans are overwhelmingly confused as well as concerned about what this bill actually does. They don't know just what the new law does in its entirety. They don't know what it's going to cost, and there's no surprise considering the actual bill's over 2,500 pages, and I've yet to run into anybody who's looked at this bill and understands completely what's involved in all 2,500 plus pages. I want to go backwards so we can go forwards. First, I want to talk about the changes that went into effect in 2010. On the tax side, small businesses with up to 25 employees earning $40,000 a year or less will get a tax credit of 35% of the cost of providing health benefits to their employees. And of course, the 10% excise penalty that went into effect on indoor tanning services, which started in July 1 of 2010. On the healthcare side, this is significant. Insurers can't deny coverage to children for pre-existing conditions, and they have to let children stay on their parents through plan age 26. I don't know if anybody in here has kids in college that have graduated that can't find a job. This is one of the things in the bill that I'm very thrilled to see it in there, and hopefully whatever happens, whether this thing gets repealed or changed, I hope this piece stays in, because I've got kids right now on my health plan, and I think it's wonderful. I'm not happy about paying for it, but I'm glad they're on it. They also can't set lifetime limits on plan coverage. And finally, Medicare Part D recipients who enter the donut hole will get rebates and discounts on prescription drug coverage. For those of you who don't know what the donut hole actually is, it's a gap in prescription coverage where the government pays nothing and beneficiaries pay the full cost of drugs themselves. I don't know if anyone in here has relatives that are on Medicare, that are on prescription. That's what the donut hole is, and it's kind of controversial because they have to pay so much money, and and then all of a sudden they're paying 100%, and then when their dollar amount gets above a certain amount, it's supposed to be paid for, completely at 100%. 2011, employers will have to report the full value of health benefits they provide employees on Form W-2. If anybody in here is a W-2 employee, you saw on your W-2 or your 1099 at year end what the cost that your employee paid for the cost of your health insurance. That doesn't mean the benefits are going to be taxable, but employers will face penalties at some point down the road if they don't provide that information. On the healthcare side, Medicare Part D recipients entering the donut hole now qualify for discounts rather than rebates. That's a little bit different than the previous slide that we talked about. Here's the big one. This is probably the one that I think is most controversial for anybody that has incomes above $250,000 for a married couple or a single individual making above $200,000. Right now, medical and dental expenses are deductible if they exceed 7.5% of your adjusted gross income, or AGI, unless, of course, you're subject to the alternative minimum tax, in which case they have to exceed 10% of your adjusted gross income. Starting in 2013, the floor rises to 10% of AGI for everyone, unless, of course, you're 65 or older, in which case it stays at 7.5% of AGI, unless, of course, you're 65 and subject to AMT, and it goes right back up to 10% again. If you participate in a healthcare flexible spending account at your job, contributions will be capped at $2,500 per year with no contributions of any kind for over-the-counter medications. If your earned income is above $200,000 or $250,000 if you file jointly, you'll pay an extra 0.09% Medicare tax on earned income above those amounts. That amount on that first slide, I believe, is incorrect. It's not 3.8, I believe it's 0.09. And then finally, you'll pay 3.8% of unearned income Medicare contribution on investment income if your AGI is also above those thresholds that I just mentioned. And investment income would include interest, dividends, capital gains, rents, royalties, and distributions from annuities. Now, there's one point in this bill that I have not yet been able to get clarification on, and that's potentially there's going to be a 3.8% Medicare surcharge if you have a capital gain on the sale of your principal residence, which is something that I'm not quite sure if it's in the bill or not. If anybody knows if I'm correct or wrong, you can talk to me about this afterwards. But it was something that I had gone to a couple presentations about, and someone had said to me that it was in fact in the legislation. (2014) Employers with more than 50 employees will have to offer health benefits or pay a penalty up to $2,000 per employee. Generally, employers will have to pick up at least 50% of the cost of the premium. There's also a 90-day limit on waiting periods before employees have to be offered health insurance coverage. Most individuals who aren't covered through their employer will have to maintain minimum essential coverage or pay individual penalties. I'm still looking for a definition of what the government believes to be minimum essential coverage. I have no idea what that definition actually is in the scope of the entire legislation. Insurance companies can't deny coverage for anyone with pre-existing conditions, and the plans can't set annual limits on coverage. Remember, the ban on lifetime limits went in effect in 2010. This is addressing annual limits on how much the insurance company will pay if you had a catastrophic illness. And finally, the law requires states to establish insurance exchanges where individuals and small businesses can comparison shop for insurance. Yes, sir.
Are you saying there that the employer with less than 50 employees has to provide health insurance, and at the same time he has to pay for 50% of the premium?
If you have more than 50 employees, as it's written in the legislation, that's correct. 50 or more, you have to offer it to your employees, and you have to pay at least 50% of the premium.
And then less?
Less, it doesn't apply to you. Under 50 employees, from my understanding, is you're exempt. The one change in 2018, the law imposes something called an excise tax on Cadillac plans, costing more than $10,200 per year for singles, or $27,500 for families. The goal here, according to the legislation, is to simply rein in costs. Now, what costs they're talking about, I really don't have an idea. But this provision doesn't take effect till 2018, and from the people I've spoke to, most people think it probably won't ever take effect at all, or it simply won't be enforced. I want to talk about now one of the most controversial parts of the law. I know the Supreme Court's already ruled on this, and that's the individual mandate. The law says that by 2014, all Americans have to maintain minimum essential coverage, which of course we don't have a real definition for yet. If not, they face penalties starting at $95 a year, or 1% of income in 2014, and rising to $695, or 2.5% of income in 2016. After 2016, the $695 amount is indexed for inflation. Now, the government has never required us to buy any commercial products or services. If you drive a car in most states, you're mandated to buy auto insurance, but nobody says you have to buy a car. So this is going to be an interesting scenario going forward, even after the election, and well into years to come as far as where this bill ultimately winds up. Of course, there are plenty of exceptions to the rule. If you have taxable income and you're under the federal poverty line, the cost of coverage is more than 8% of your household income, you don't have to pay for this. And if your taxable income is less than 4 times the federal poverty limit, you'll get tax credits to help you pay for the coverage. Now, Here's the weirdest part of the whole law. I'm going to put a definition here up on the screen in a minute, and it was a definition that was put forth by the Joint Congressional Committee on Taxation. I've never met any of these people that got together and decided this, but I think you'll find the definition of this pretty interesting. I'll just read it. The penalty is assessed through the code and accounted for as an additional amount of federal tax owed. However, it's not subject to the enforcement provisions of Subtitle F of the code. The use of liens and seizures otherwise authorized for collection of taxes does not apply to the collection of this penalty. Non-compliance with the personal responsibility requirement to have health coverage is not subject to criminal or civil penalties under the code, and interest does not accrue for failure to pay such assessments in a timely manner. I'm glad you're laughing at this, because I just thought this was hilarious. Once again, if there's no interest, if there's no liens, if there's no levies, there's no jail time, there's no enforcement mechanism, how motivated are you going to be to comply? You know, I mean, yeah, it's just kind of bizarre, and I've yet to hear anybody, any of the talking heads on TV, ever even bring up this issue. Now, the one interesting thing is, in here they call it a penalty. The Supreme Court has now ruled that it's a tax. So, yeah. So your homework for tonight is to figure this out and give me a call tomorrow morning. What's that? I got that from a service who pulled it right out of the documentation. Yeah, actually, it was a decision. The Congressional Committee, the Joint Taxation Committee, reviewed the law and put this disclaimer in the actual law. On what page it is, I have no idea. But basically, there's no enforcement mechanism. Yes?
Well, why is the IRS involved?
That's another part of your homework. I don't have an answer for that, and every time I try to get an answer, I probably have a better chance of getting a definition for essential coverage than I do for getting a definition for that one. And all I'm looking for with my clients is to give them some type of guideline and say, here's what we have to do to comply, and I'm just getting, well, you'll have to wait. I don't want to wait till somebody shows up at my door with, hacksaws and subpoenas. Suddenly it's not fun anymore. You know what I mean? As you all know, there's going to be continuing challenges to this. This is far-reaching and has already attracted opposition in a number of states and localities, not to mention the Republican Party. And in this case, the opposition isn't folding and is not going away, even though the Supreme Court's ruled that it's legitimate, it's constitutional, and it's now the law of the land. Many prominent Republicans have vowed to overturn the law, such as Mitt Romney if he's elected in November. They don't have the votes to do it now and aren't likely to get the 67 votes needed in the Senate, which would give them the power to override a presidential veto. So chances are nothing is going to happen until after November in this situation. Most experts expect Democrats to lose seats this coming November, and if they lose enough, chances are the Republicans may be able to make a run at overturning this at some point next year. State governments have also stepped up. They're not crazy about this either. Many states are afraid it pushes way too many costs on them. I don't know if you guys heard this morning, but another city in California filed for bankruptcy. So this is just one more bill that they know is coming, and they can't afford to pay their bills now. So I told you I was going to depress you all this morning when I came in.
I think the problem with the states is that the government will fund it 90% because of Medicaid for 3 years, and then they drop off.
And then they, yeah.
And then the states are left with that.
Yeah.
Whole pot.
Exactly. Yeah. And how do you pay for it once the government pulls their
The other
funding?
thing is the government saying that with that, we've got 30 million people on Medicaid spread throughout the states. Depending on which state you're in, you have a lot of people.
Yeah. No, it's kind of scary, because how are you going to pay for all this? It's great on paper, but how do you fund this? And that's where the issue comes in. From what I understand now, a group of state attorney generals, 11 of them, have argued that the law violates states' rights. They're trying to still fight this in court in spite of what the Supreme Court has said. Politicians in 36 states have introduced legislation that would limit or oppose it. Virginia, for example, passed a law making it illegal for the federal government to require Americans to buy health insurance. We live in interesting times. Opponents have also objected to the mandate as unconstitutional. We now know that it's a tax, so in their minds it is constitutional. But we know the Supreme Court has sided with the current administration on this issue. Where it goes from here, it's one of those great mysteries of life. So where do we go from here? There's no doubt that what we've just seen is the first step in an ongoing process. I want to remind you that for your clients, there are already concepts in place to help them mitigate some of the costs of health insurance coverage they're already paying for. I don't know if anyone here is familiar with the Section 104 Medical Expense Reimbursement Plan. It's a way for you to deduct 100% of your business health insurance costs as 100% without the AGI floor that you have on Schedule A. If you have any questions about that, shoot me an email and I'll send you some information on it. So let's move on. Glad you all had a big breakfast, because I know this is not stuff you want to have on an empty stomach, you know. Talk a little bit now about marginal tax rates and where tax rates have been before I get into the Bush tax cuts, which are also set to expire at the end of this year. When Congress first imposed the first tax rate in 1913, the top rate was just 7%. The rate soared to 73% after World War I, and then dropped to 24% in 1929, and 25% for the first 2 years of the Great Depression. Then climbed to 92% in the Eisenhower administration, but has since then dropped to 31% during the first Bush administration, 39.6% during the Clinton years, and back down to 35% from 2003 until today. President Obama campaigned with a pledge to cut taxes for families making under $250,000 and to bring taxes down to 18% of gross domestic product. That would put them at the same level when Ronald Reagan was president. And in fact, many of the changes he's proposed, such as new top rates on dividends and capital gains, would leave rates on net income lower than they were under Ronald Reagan. But that goal may be harder today with the economy and unemployment at 8% than it would have been when candidate Obama was running for the office. And as it turns out, with the slow economy, taxes as a percentage of GDP are lower than they've been in actually 60 years. The biggest challenge Washington's facing now is what to do about the Bush administration's tax cuts that were enacted in 2001 and 2003. Those cuts were scheduled to expire at the end of 2010. Taxes would rise across the board, with a rate going from 35 to 39.6%. Democrats, including the president, wanted to extend those cuts for families earning up to $250,000. Republicans wanted to extend them for everyone. In the end, the Tax Relief, Unemployment Insurance Reauthorization, and Job Creation Act of 2010 wound up extending the Bush tax cuts for 2 years through the end of 2012. What will happen after November's election is anybody's guess. Does anyone ever notice in here whenever they pass a bill, whatever the bill sounds like, it never seems to wind up actually doing what the bill's called? Maybe that's just me. I'm probably more cynical than most people, but I've yet to see the job creation from this bill occur. So, you know. Now let's talk about capital gains. These gains are the gains you earn from the sale of property which you've held for 12 months or longer. The key point here, as you know, is you don't pay any tax on this till you actually sell the property. It makes sense that rates are lower for capital gains. That's because inflation pushes up the value of your assets, even if they don't grow in real terms. We've all heard stories of friends or relatives who bought a stock for a few $1,000s and then wound up selling it years later for a few $100,000. Maybe someone in here is lucky enough to have purchased Apple when it was $7 or $8 a share many, many years ago. Well, how much of that gain is actually due to inflation and the devalue of our currency, and how much is real appreciation? The current law caps most capital gains at 15%. However, if the Bush tax cuts expire in 2013, that rate goes to 20%. While those rates may go up, there's still lots of opportunities to use capital gains. If any of your clients own a business, they have two ways to profit. They can take income out of the business, as you know, or simply grow the value of that business and defer the tax on that till they sell the business down the road. Let's talk about something now called a special category of income called qualified corporate dividends. Most publicly traded corporations and some smaller, closely held businesses pay corporate tax rates up to 35%. If they pay dividends, you'll pay tax again on those dividends, and that's the infamous double taxation. Ronald Reagan actually suggested eliminating corporate taxes altogether on the theory that the corporate income eventually winds up on the shareholder's tax return anyway. But that's not politically feasible with a country that's $16 trillion in debt. So the Bush administration settled for taxing corporate dividends at lower rates, just like capital gains. How many people in this room have friends or relatives or clients that are living on their dividends right now? Well, we all know what's going to happen when these go away. That's all going to be added in, and you're going to be taxed at your potentially highest marginal tax bracket. Yeah, plus. Yeah. Currently, that rate is 15%, and like with capital gains, it's scheduled to go back to 20% in 2013. In fact, the administration has proposed to end the preferential rate entirely, which would raise rates as high as 39.6%. New rates on capital gains and qualified dividends will make tax planning an even more important part of your overall tax planning for yourself and your clients. You'll need to pay more attention to which investments you hold in taxable accounts and which you hold in tax-deductible accounts or tax-deferred accounts like your IRAs. We also saw a struggle to extend the payroll tax cut that was passed for 2011. This can mean a savings of up to $2,136 for someone earning at or above the Social Security wage base. Of course, when Washington plays with the tax code, they give with one hand and taketh away with the other. In exchange for the temporary tax relief, they eliminated the Making Work Pay credit, which was $400 for individuals and $800 for joint filers. This ironically means the taxes went up for individuals with earned income up to $20,000 and joint filers with earned income up to $40,000, which you saw when you filed, if anybody filed a tax return for 2011, was somebody whose income fell in those two categories. Their income taxes actually went higher in spite of the payroll tax relief. It's my favorite slide. Let's talk about the estate tax, just because it's really a big deal for anyone who's subject to it. Everybody knows what the unified credit is, which is the amount actually subject to tax. It went from $600,000 to $3.5 million. And the rate itself went down from 55 to 45. Then it disappeared entirely in 2010. Then it came back to life January 1 in 2011. At that point, there was a $1 million per person unified credit, which is the amount you can bequeath tax-free, and a 55% rate. Back in the late 90s, when President Clinton signed the law gradually cutting the estate tax, everyone assumed, including me, that Congress would act again with a permanent fix. Conventional wisdom held we'd see unified credit between $3.5 to $5 million and a rate somewhere around 40%. Well, Congress, as usual, did nothing. Then when 2010 started with no tax in place, we all assumed Congress would pass something retroactive so it wouldn't go away. But Congress never acted. And in 2010, George Steinbrenner and several other American billionaires died estate tax-free. Now that's a great estate tax plan if I've ever seen one. Just let me know if you're going to die in 2010 and you won't pay anything. At the end of 2010, the lame duck Congress approved a new regime. The unified credit was raised to $5 million per person. The rate was lowered to 35, but those rules apply only for 2011 and 2012. Unless Washington acts again in 2013, the credit drops back to $1 million and the rate goes back up to 55%. President Obama promised to pay for tax cuts by cutting spending, closing corporate tax loopholes for those evil corporations, and cracking down on offshore tax evasion. But how realistic is this plan? And how likely will he be able to keep his promise? When President Bush took office, we supposedly had an actual budget surplus, if you accept the government's own accounting rules. Since then, the combination of lower taxes, higher spending, and higher defense budget has pushed the deficit up to record levels. For 2010, the OMB reported a deficit of $1.3 trillion. That's $4,000 for every man, woman, and child in this country. The total national debt has topped $15 trillion. That's over $35,000 for each of us. What's worse, the economy that produces actual taxable income has stalled. Recent reports have reported that in some areas the economy is picking up steam, but unemployment is still stubbornly above 8%. And the real estate market, as we all know, is still somewhat underwater. Back in '08, when Obama was campaigning, it was easy to propose tax hikes for Wall Street millionaires. But since then, Wall Street's laid off over 100,000 people. That's a lot fewer millionaires to pay the tax. President Obama still pledges to keep taxes down for the middle class. But 3.5 years into this economy, is that even possible? A few minutes ago, I talked about the Bush tax cuts extensions, and I said the long-term outlook was very unclear. Let's take a look at prospects for the cuts after they're scheduled to end at the end of this year. Back in '08, when Obama first won election, a lot of observers expected taxes to go up. Why? Because an incoming Democratic president, backed by a Democratic House and Senate, would raise taxes to pay for 2 wars the previous president had put on the country's credit card. But a funny thing happened. Democrats and Republicans agreed, for the first time that I can ever remember, that there was no time during this recession to raise taxes, and in fact, they actually cut taxes in a variety of areas. Then 2010 rolled around, and the Bush tax cuts were set to expire. Obama and the Democrats were just committed as ever to extending those for the middle class. They made noise about going back to the Clinton-era marginal rates for the rich, which they defined as $200,000 as an individual and $250,000 for a married couple. But eventually President Obama compromised and extended the breaks for everyone. I don't know about you, but I have a large number of clients that live in New York City making over $200,000 a year, and they don't look at themselves as being rich. So a lot of this is really going to affect people based on what you make and also where you live. Yep. Then we hit the debt ceiling, and Obama proposed a grand bargain involving $3 trillion in spending cuts and $1 trillion in new revenue. But the Republicans, dominated by the new Tea Party members, told us no. And they really meant it. They were even willing to risk a possible government default and a partial shutdown rather than raise revenue. So should we worry about tax hikes in the future? Well, here's why we should. You see, the tax cuts are set to expire at the end of this year. If Congress and the White House don't act affirmatively together to extend them, they're gone. And if Obama keeps the White House, he can raise taxes without having to do anything. And that means not even going through Congress at all. He just has to let the Bush tax cuts expire and let ObamaCare kick in. Neither the administration nor the congressional Democrats appear to have any specific appetite for raising rates on the middle class, but the leverage in the debate will shift sharply away from those who stonewalled those tax hikes just recently. If Obama wins re-election, he'll be in a position to tell the Republicans, look, here's the deal. I'll give you the tax cut you want for the middle class, but I refuse to extend them yet again for millionaires and billionaires who aren't paying their fair share to balance the budget. Of course, a lot of this speculation turns on, once again, who wins the White House later this year. The Republican nominee is settled. It's Mitt Romney, and he said he would keep marginal rates at their current level and further reduce taxes on savings, eliminate the estate tax, and cut corporate taxes to 25%. And in fact, Republicans keep the House of Representatives and whittle away at the Democratic majority, they might cut taxes even further. Remember, if Obama should win, and no majority can be reached by the Senate Republicans, Obama needs to do nothing, and taxes will increase on just about everyone. And let's not forget the alternative minimum tax, which could hit over 28 million people in 2012. I want to shift the focus here briefly to how I think you ought to consider investing as we move forward in this era of high taxation and low growth in the economy. One of the key issues I address with clients every day is the importance of not losing money when you invest. Now, why is that important? Let's look at the column here on the far left-hand side, and let's look back to the bear market in 2008. While the S&P was down 54%, which was the biggest single decline in the history of the stock market, if your portfolio was down 40%, you'd need 67% return on your portfolio just to break even. Now, if you're a big believer in what Bill Gross said a few months ago, that he felt that total return for the equity markets going forward would be around 5%, if that's the case, it would take you at 5% 10.5 years just to break even. That's assuming no other bear markets or sell-offs in the markets going forward. If you were lucky enough to only lose 30% of your money during the last sell-off, you'd need 43% to break even. So if the market returned 5%, it would take you 7.3 years. If we go back into a recession and your investments earn 3%, then you're looking at 12.1 years. So once again, the key important issue here is, as you invest, you need to consider things that at least give you some type of a guarantee of your principal. And we'll talk about another issue later on in a few more slides, something called a risk-adjusted rate of return. The next thing I want to talk about is total return. And I'll just read to you what this says. This was actually a study done by First Trust, which is a money management firm, I believe, located in Chicago. If you'd invested $100,000 in large company stocks at the end of 1925 with dividends reinvested, your investment would have grown to $2 million, $45,255 by the year ending 2008, right before the bear market began. An average annualized return of 9.62%. Capital appreciation alone would have only grown to $70,789 over that same 83-year period, for an average annualized return of 5.27%. Now, of course, this doesn't take into account the scary sell-offs and bear markets that you would have gone through along the way in that 83-year period. And this is very cold comfort to somebody who was getting ready to retire with a $1 million IRA in 2007, only to see their portfolio fall by 40%. But one of the big issues you have to consider going forward is dividends are going to play an increasingly larger and larger component of investing as we go forward. And this is just a classic example of how it's been like this for over 83 years. This is not something new. More and more people on television, on Bloomberg and CNBC, are saying, you got to look for dividends, you got to look for something that's going to give you income, because we all know the yield this morning on the 10-year Treasury was 1.45%, which isn't even enough to keep you ahead of inflation and taxes. This is an option to consider. I'm sure a lot of people in this room have listened to other radio talk shows on Saturday mornings, and you've heard people talk about something called an indexed annuity. I'm not going to go into great detail, but this is an actual account. It's actually one of mine. And if you'll look on the left-hand side, it's in the illustration here. On your anniversary, you'll see where the S&P index was at, I know some of you probably can't see this, it was around 13.7. This middle column here is the actual S&P value, and here's the asset value and what was the index annuity. As you go along here, you can see this goes right from 2000 to 2004, which was the tech bubble, where everybody lost a lot of money on companies that had no earnings. Surprise, surprise. If you look here, you'll see your account value went up in 2000 to 66,000. From that point on, it went down to 52,000 by the end of 04. Over here, you had 3 years where your account value didn't go up, but it didn't go down. Those were years where you didn't lose any money when the market went lower. So when the market turned in 03, your account value went from 65 to 72,000, and then from 04, it went to 76,000. So once again, going forward, risk management, risk control is going to be more and more of an important issue for everybody who's looking to invest their assets and not be constantly waiting to break even. Here's an interesting chart. This is the Nikkei. The interesting part about this chart is you can see starting in 1990, they've been in roughly a bear market for 20 years. Now, why is that interesting? Well, we're mimicking their fiscal and monetary policy. Zero interest rates, somehow deciding that they're going to boost the economy and boost economic growth. Anyone's heard the phrase push the string? Well, it's not working, okay? We've just finished in this country, and you've heard people talk about it, a lost decade. If you look at a chart of the Dow from 2000 to 2010, what you'll see is something like this piece right here. The market's gone sideways to lower. So once again, if you had nothing in your portfolio that could guarantee your principal or mitigate these sell-offs, you can see here, yeah, buy and hold worked great up to 1990, but then from that point on, you've been in a 20-year bear market. Now, who's to say we're going to go through another 10 years of a lost decade? Based on what's happening now with the new tax policy and slow growth in the economy, our corporations are making more money, but they've laid off a third of their workforce. So if they're making all this stuff and people are laid off, I know this is simplistic, but who's going to buy it? The last thing I want to talk about is something called risk-adjusted return. Anybody in here ever heard about pork belly futures? You know how risky that stuff is? Okay. Well, a risk-adjusted rate of return, and I'll use this as an example. Say you had two investment scenarios you were considering. Both were yielding you, say, 7% historically, over a 20-year period. One had a risk-adjusted rate of return of 1, which would mean very low risk, and one had a risk-adjusted return of 10, meaning very high risk. Okay? Now, granted, there would be all types of other illustrations or other investment scenarios within that range, but for someone who's just lost 40% of their money, okay, something that's going to yield them 7% potentially over time, that risk-adjusted return is going to help them, sleep better. Now, if you're one of those people that likes to spin the wheel and take big risks, then maybe the one on the opposite end of the spectrum would be a better alternative for you. But these are things that people really have to get serious about and look into, because there are a lot of money managers right now that I use in my practice that when the S&P fell down 54% in 08, their overall moderate portfolios were down about 8.5%. So from the chart I showed you earlier, if you're only down 8.5%, it's a lot easier for you to recover from that type of a sell-off than when you're down 54% and you need huge outside double-digit returns just to get back to where you were, and that's assuming the economy is going to improve. And now that I've depressed you enough, the last slide. Here's your bottom line. You can't afford to wait until tax time to face the music, and really neither can your clients. You can't afford to risk another April 15th surprise. The key to beating any future tax changes is through tax planning. It doesn't matter how good you are or how good I am with a stack of receipts on April 15th. The year that just ended is over. It's done. There's very little you can do for a year that's just ended to reduce your client's tax liabilities. I know it's hard to get people to sit down and want to talk to you about tax planning in January for that year, but once the year's over, it's done. It's done. There's very little that can be done. So that's my presentation. If anybody has any questions, they want to throw a shoe at me or something, I mean, that's fine. I'm older now, but I can move pretty quick. Yes, sir. If you have my business card, you can shoot me an email, and I'll actually send you a documented track record so you can see it for yourself. I knew that question was going to come up from somebody, so I prepared for that. Any other questions? Thank you all. Gentleman in the back.
I have a question about how they're defining a business for the requirement for 50 employees or more. For instance, if you have 3 businesses with common ownership, and again, I'm not sure how they define that, of 20 employees each, are they going to require each of those businesses to cover the health care?
That's what I'm trying to find out. I've got clients right now that have 3 businesses that are 54 employees, and they're calling me up and saying, what if I split these businesses up into 2 other corporations with 2 other separate tax IDs? I'm hoping that that's doable, but I'm sure what we're talking about isn't new. I'm sure some weasel in Washington has already figured out that, hey, you know what? People are going to try to do this to mitigate it. Oh, what a concept. Yeah, it's going to happen. So I would love to get, some clarification on that. Good question, by the way. Any other questions? Well, thank you all. There's a form that I passed out.